All right. What's up, guys? I hope you're doing well. James here from jamesdforesight.com. And I wanted to go a little bit over about a recent Fed speech from Fed Governor Michelle Bowman, mostly about the kind of technological aspects that are kind of developing for the banking system in general. And this is involving like AI, some crypto related services, and other things that banks are starting to look more into. And that the Fed is kind of realizing that they have to start providing kind of regulatory guidelines in a way. So with that being said, we'll head right over to a screen share, switch it over. There we go. And I'll zoom in for you guys. So it looks like it's a little, let me check to see that it's good for it. Yeah. So it's easy for you guys to see as well. So kind of just skipping throughout the speech to get the main points. And so basically more and more customers interact with their banks exclusively through digital channels. This is one thing that I've been noticing. So they check their balances, apply for credit cards, or make deposits and payments via their phones rather than visiting bank branches, which honestly I can see that. There's been so many times that I'd rather just do everything banking wise through my phone. At least that's how I do 99% of all my banking stuff, because I'm not even in the same state as my bank is. So not anymore, at least. And I only really do the in-house bank stuff, I guess you could say, whenever I go home. But to continue, changes are not just the changes for how people are banking aren't just involving not going to an actual physical branch. Technology is also changing fundamental aspects of banking operations. And so this is, as an example, banks are beginning to use AI, artificial intelligence, in credit underwriting, bank office operations, and various aspects of risk management and customer service, right? So they're kind of implementing that AI, that is, in multiple respects, right? Basically just kind of streamlining and making things more efficient. And then it is true that new services and products present new risks, but these are not unmanageable risks. And frankly, there is greater risk in standing still and not recognizing the need to move forward. Failure to innovate can undermine a bank's competitiveness, posing a threat to safety and soundness just as innovating recklessly can, right? And so this is kind of, I wouldn't necessarily say it's a change in tune for how kind of regulators typically act. Because normally you're pretty much like, okay, they deem like almost, it seems like they deem everything historically to be recklessly innovative, right? And so, yeah, she says that in there, but also talking about how now, and I'm starting to notice more and more things are kind of having this twist to it, to where it's like they need to innovate because else they'll become uncompetitive and not able to move forward. And kind of the first example that comes to mind is with central bank digital currencies, right? Which do appear in the speech later on, and we'll get into in a second. But that's kind of almost a change in tune that I've noticed. So first off, with respect to crypto, this is something we've talked about a few times, and I have quite a few videos at this point about kind of how banks are dealing with crypto. And of course, you can find them throughout the channel. So kind of different reasons why this is important, right? So first, although the interests seem to have cooled off lately, meaning the interest that consumers have in kind of crypto related services through banks, given recent developments in the crypto industry, we have seen significant consumer demand for engagement in these types of services. It seems reasonable that because bank customers are aware of crypto and have discussed these assets with their banks, banks want to better understand this type of engagement and potentially provide those services to their customers. And the reason for that's kind of related in the second reason. So we have also been told that banks have observed their deposits flowing to non-bank crypto asset firms. And understandably, they would like to stem this outflow by offering the services themselves, which, I mean, that makes sense from a business perspective, right? They don't want their customers to go somewhere else and for a different service that they aren't providing, especially when it's related and they can basically just add that on to their typical services, right? And so that's one thing to keep in mind. And so the Federal Reserve staff is working to articulate supervisory expectations, wow, for banks on a variety of digital asset related activities. And this includes the custody of crypto assets, facilitation of customer purchases and sales of crypto assets, so like trading, it seems, loans collateralized by crypto assets, and then issuance and distribution of stablecoins by banking organizations, right? And so that might be, now that I read that fourth point, it kind of reminds me of during the 1800s and before the Federal Reserve came about, when we had like the system, especially from the before the National Banking Act of 1863, right? When you kind of had the issuance of kind of more of a national currency, and you kind of had the typical banking structure start to come into place that we saw before the Federal Reserve, where you had the country reserve banks, and then you had the reserve city banks, and then you had the central reserve city banks, and they all kind of had tiered reserves and a bunch of other stuff. That's not the purpose of the video, but just to kind of get into that. What my point is, this maybe the stable coins for banking organizations with respect to what we're talking here might be turn into something similar that we saw with like state banks having their own currencies during that time period. And so maybe it would be kind of a decentralized currency in terms of the banking system, which just a thought that popped in my head right now. And so that'd be interesting to see if that develops, to be honest. Not sure off the bat if there would be different implications or effects from that in the system or what. But I don't know, it'd be an interesting development and something to think about. But, and the first two especially, I've noticed especially with my brokerage that I use, they really are starting to get into custodying and then basically trading crypto, which wasn't really an option before. And this, I'm talking about like typical brokerage. I don't know if Vanguard does it, but I know IBKR is starting to do it, which is who I use. And then loans collateralized by crypto assets. I know firms like BlockFi do it because I did something through them a while ago. But that's one of those, I lost the password, to be honest, and I need to figure that stuff out, and that's kind of my own bad. But anyways, sorry for the rant. To continue, earlier this week, they released supervisory guidance addressing banks that are engaging in or seeking to engage in crypto asset related activities. And they give a link to their kind of guidelines in the third reference right here that you can find to. And of course, as always, I'll put the link to this webpage in the description so you guys can read the speech yourself and look at the sources and everything. And when you do that, if you have comments related to not only the speech, but also like the references that they use themselves, please feel free to comment it, start a discussion. That's the whole point of this stuff, right? So with regards to artificial intelligence, the Federal Reserve is taking a similar approach with respect to banks' use of AI. Last year, the Fed joined with 4 other financial agencies to issue a request for information and comment on financial institutions' use of artificial intelligence, including machine learning. And I'm interested to see that each one of these letters are the first letter. It's written like it's a title. So is this actually what they called the thing? I don't know, but maybe it's like a paper or something where that's what they called it, because they love their long titles for some reason. But anyway, so banks are using AI in a variety of ways, including fraud monitoring, personalization of customer services, credit decisions, risk management, and textual analysis. I mean, there's some things that you can kind of have. Let's say there's some aspects of banking in which you have to have that personal component. You need to talk to an actual person. There has to be that kind of personalized aspect. But a lot of it, I guess, could be essentially used through AI, which it seems like they're experimenting with, or maybe have some form of basically just streamlined through technology to make it more efficient in a way. So that'd be interesting to see how that develops as well. So in terms of payments, and we're talking about FedNow and CBDCs, so the FedNow service will enable financial institutions of every size and in every community across America to provide safe and efficient instant payment services. It is intended to be a flexible, neutral platform that will support a broad variety of instant payments. It will allow depository institutions and their service providers to offer value-added services to their customers, ultimately enhancing competition in the market for payment services. completing and implementing FedNow is a high priority, and they expect it to be done by mid-2023, right? So a little less than a year as of this recording. And that being said, I've also seen, and talk a little bit about in this paragraph here, basically the implementation of FedNow almost seems like it would kind of negate a lot of the selling points for issuing a CBDC. Maybe not all of them. You'd have to look at it on a case-by-case basis. But it's definitely an interesting development because one of the major selling points for a CBDC is this instant payments for anybody, right, who has access to such a CBDC, much like cash, right? And then also have kind of their own words, the safest form of money, to where there's essentially no counterparty risk as they define it. I want to throw that caveat in there and things along those lines. So maybe the implementation of FedNow on a grand scale would basically negate the use of a CBDC, or at least in some respects. But that's something that I will be looking more in depth into to see how exactly is this FedNow service working. Maybe actually finding like a manual or however they're going to talk about it, or if I can even get my hands on that, we'll see. But anyways, that's something I'll be looking for, and we'll probably make some videos on later whenever I find it. So their expectation is that FedNow addresses the issues that some have raised about the need for a CBDC, like I was talking about. And I'm sure, as you are already aware, earlier this year, we published a discussion paper that outlined some design principles, costs, and benefits of a CBDC and solicited public comments. And then they received a bunch and they're reviewing them. I did go over this specific paper that they're talking about. So when you find here in the 5th reference, money and payments, the US dollar in the age of a digital transformation, I'll try to find the videos and put those in the description as well, or put it as like an info card or something in the video to make it easier for you guys to find them. But I did go over this exact PDF and made videos about it, so that's out there as well. And that paper was published in January of 2022, right? So in terms of charters and stuff too, I was quite surprised to read this because it's not something I followed very in depth. But apparently in recent years, there have been an increase in novel charter types being authorized or considered across the country at the state and national levels in terms of banks being chartered to be a part of the Federal Reserve System, right? So as a result, Federal Reserve banks are receiving an increased number of inquiries and requests for access to reserve bank master accounts in financial services, which could provide those institutions with access to the nation's payment system, right? So it seems like basically more and more financial institutions or banks or just entities in general are trying to basically get reserve accounts at the Fed, is what it kind of seems to me of what's happening. Maybe that's because they think that would be very helpful. Maybe they need more of an explicit kind of form of government liquidity in a way. And I know the lines between the Federal Reserve and government are somewhat blurred, and there's a lot of nuance and technicalities in there that need to be explained. And I do have some videos on that already. I'm working on more in terms of, and you can find those in the Federal Reserve playlist as I go over them, to really kind of look at the history and how the Fed and the government are kind of working together in a way. Like I said, there's a lot of nuances. That's way too much to do in one video. But that's the thing. So to conclude, the approach articulated in the guidelines is based on the foundation of risk management and mitigation, recognizing that access to Fed accounts and services can create significant risks. The systematic evaluation of these different risks is intended to establish a framework ensuring similar treatment for legally eligible institutions with similar risk profiles across the reserve banks, right? And so it's just something to keep in mind, right? So basically some of the biggest takeaways from this speech in general, at least that I got, was really kind of the regulatory guidelines that the Fed is going to be using or is searching for / developing, whatever, with respect to both artificial intelligence and crypto services in the banking system in general. So basically kind of reforming the monetary system in a way, or at least we'll say modernizing, it seems. seems to be a good word. So yeah, and then also keeping an eye on the Fed Now service and CBDCs, because that's also seems to be development worth paying attention to. But anyways, with that being said, I'm going to leave this here. So I hope you guys have a good night, and I will see you on the next one.